We're thrilled to partner with Cohort Invest for this podcast series. Financial promotion is a regulated area in the UK, so I'll read the message approved by Cohort's legal counsel. They offer unique investment opportunities in unregulated property-backed bridge loans, providing 8% plus representative APR with monthly interest payouts. Loans are typically below 65% loan-to-value, offering a safety margin if values decline. The Cohort Invest team combines banking, legal, and property expertise to internally assess and verify asset values alongside traditional third-party valuations. Since 2018, they haven't lost any capital or interest. Explore investment opportunities at cohortinvest.co.uk. And remember, your capital is at risk. Now, on with the show. Hi, and welcome to the Return Property and Investment Podcast. I'm Anna, and I'm delighted to be joined by Adam Lawrence, who's the founder of Propenomix, which has many thousands of subscribers across platforms who are keen to explore the economics of property. He's been involved with over 700 UK property deals in the last decade, using 8 figures of joint venture funding and retaining the vast majority. He co-owns multiple investment and asset management companies that provide end-to-end services for residential property investors. And he is my favourite source of insight on property economics and finance. So welcome to the podcast, Adam, and thank you so much for joining me.
Thanks for having me, Anna. And the last bit was the most important, I'm sure. Thank you.
Yes. So today we're going to focus on whether you should have property in your portfolio in the current environment and how. It's a really important question for investors of all shapes and sizes. So let's get started with a question about the pros and cons of holding your property in your portfolio in the current economic and also crucially regulatory climate. Everybody has their own unique circumstances, and property investment itself has special challenges and opportunities. But I wondered if you could just start by sharing some of the general pros and cons of holding property in your portfolio right now.
Sure thing. So I think you've always got to consider effort. And when regulatory environments change, effort goes up, re-educating yourself, thinking about how it changes your direct strategy, things like that. So that's the first thing to be aware of, probably. Effort. People sometimes make that mistake, or they get sold the dream of direct property investment, as if it's going to be particularly passive, at a simple level. Even if you employ a very good agent to do everything for you, there are still decisions that need to be taken by you at the top level. So it's a bit like when you build a bigger organization, there are more things to deal with, and you might get a smaller percentage of the things to deal with, but the things you get to deal with go up in importance, if you like, in terms of the importance to your investment returns and the importance to your ongoing business as a whole, I guess. So we have to start there, really, Anna, I think, and just make that point. That's always the case. But where we are at the moment, we've had the most significant changes in the cost of capital, the cost of debt, apart from anything else, that we've had since 2008, realistically. But of course, it's gone the other way, largely speaking. Of course, post 08, early 09, the problem was not really the price of credit. The problem was that no one really wanted to extend it. And so availability was through the floor. Whereas what we had since the sort of really earlier on in 2022, but dramatically sped up in the autumn of 22, when Liz Truss and Kwasi Kwarteng were in charge of the purse strings, is a massive change upwards in the cost of debt. So it created quite a dichotomous market, really. For those who saw it coming, they managed to fix mortgages. But of course, because we're in the UK, they're really only fixing for 5 years at a time. The occasional organisation and bigger organisations will, of course, fix for longer periods. There'll have been some 10-year and there'll have been some longer term bonds for housing associations and the likes. But generally speaking, us as direct investors could fix for 5 years. And that's all fine. That takes you up to 2027, where certainly my thoughts were things will have blown over by then, largely speaking. I'm not a huge fan of forecasting in detail 5 years out. But of course, what it also changed was, if you've got a business that also requires new units, relies on acquisition and new stock, and ultimately trying to grow a portfolio, then you've still got to fund your new acquisitions as well. And the maths and the economics behind all of that changed quite dramatically at a fairly strong pace. And we're still seeing a market that is having to cope with the fallout of that, really, in terms of lagging inflation on rents, in terms of availability of stock for people who are looking, and in terms of affordability as well, realistically, because there'll always be a ceiling in terms of what tenants can afford. It doesn't really matter how much you need to pay your mortgage. If no one can afford to pay the rent that requires you to pay your mortgage, then it's not going to work.
Okay. So we've got the cost of debt has gone up. And in many cases, that makes debt not accretive to a strategy if it's a simple strategy, not a value add strategy. And we've got much more effort as a result of regulations. Are there any other kind of pros and cons that you can shed some light on, both the situation and also what's changed in recent months and years?
Well, I think when you see ultimately, there's plenty of, it's a strange thing because people refer to the sort of broadly the housing market's broken, the rental market's broken, and all these sorts of things. Whereas really, it's a bit more complex than that. There are parts where things still function reasonably. There's a decent supply of stock, and there are parts where there just isn't. And the same goes for property development and new units as it goes. It's the product mix really that causes the problem when you deep dive into the stats, not really the number of units that we have available, because we've got more units per capita available than we had 50 years ago. Most people, and quite a lot more units actually per capita. But of course, we've had changes in household structures, changes in culture to an extent, and that means that it looks worse than it is in many ways. But short of a big shift back to multi-generational living or something like that, which is unlikely on a mass scale, you would think, it leaves behind bigger problems. So I think you've got to consider, what are you involved in, and what are the substitutes for that? Also, if you had, for example, always bought 3-bed semis near reasonably good schools, a pretty easy strategy for anybody to understand. What's changed that sort of stock? Well, if the good school stayed a good school, they've become more and more in demand as population has grown and things like that. Some of those houses might have been used to be extended, turned into HMOs, things like that, or single family homes that have been extended that then are outside the reach of the rental market in terms of their capital value and things like that. And then you look at where are the new units that have been delivered when it comes to 3 beds, whether they be semis or townhouses or whatever, and new infrastructure that's been put in around there and in place, and it really hasn't been sufficient. So the supply is nowhere near kept up with the demand. So there are all these pockets of individual. And it's very easy to see. If you give me a simple example, if you just went on Rightmove and typed in the city centre of your choice and looked at how many flats there are available on the market, how many are sold subject to contract, and how many are on the market for sale, you normally find in most city centres quite a big bias towards stuff that's sitting on the market unsold. Whereas if you go and do what I just said and look at a nice suburb with 3-bed semis, you'll find a very small amount of stock, normally speaking, and a large amount of that will already be sold subject to contracts as well.
Okay, super helpful. And just on that pros and cons of holding property in your portfolio, I mean, we talk about direct and indirect property ownership. If you are someone who looks at direct property ownership in your portfolio, let's say before you were buying at whatever yield, we can pick a number, buying 3-bedroom semi properties that you just described and buying at a particular yield, which fill in the blanks. How much more do you need in terms of yields now that debt costs are higher, and therefore what's changed in terms of the numbers?
Okay, yeah, that's good. Yeah, it makes lots of sense. It's a really good question because you see, and this is what happens in situations where there are fairly big changes in small amounts of time. I've seen some very positive articles saying, well, yields have never been so great, but of course they're talking about gross yields. And if you, to try and fill in some of your blanks, if you pick a number and say, well, it would have been perfectly acceptable when debt was maybe, let's call it 3.5% a year, to buy a 3-bed semi with a 6% gross yield, allowed maybe 25% of that for management, maintenance, compliance and the likes. So that'll take you down to 4.5. And then 3.5 is, of course, as a cost of debt, is giving you some positive leverage. So you will always, in these cases, when you're holding or direct or indirect, ultimately you're probably looking to make the majority of your money from appreciation over time. And that's a good strategy because apart from anything else, it's quite tax efficient, usually only paying the tax upon the disposal event, depending on how you do that disposal. Whereas now, if you think, well, actually, you know what, the yield on these has gone up to, let's again pick a number to fill in the blanks, 7.5%. But the problem remains, well, cheapest cost of debt as we're recording this for a limited company, buy to let, is about 5.75%. So if you take your 7.5% top line and then you take off your 25% of that of costs, you'll find that's 1.75%. And that takes you all the way back down to 5.75. So you're not gearing up anymore. You're gearing to break even, which increases your risk, suppresses your returns on equity. Pick your metrics, but whether you look at it risk adjusted or not, it doesn't look better than it did. And in order for those numbers to be equivalent effectively, well, when I was at 3.5% in my first example over 6, that was about 58, 59% in terms of the cost of debt, whereas now we're talking about 75%. So either the rates need to go down, which of course they are going down, albeit pretty slowly, but either the rates need to come down and or the yields need to keep rising. And for the yields to rise, ultimately, the rental growth has got to outpace the capital growth. And of course, that's not been difficult over the last 2 years, but it might be more difficult as the market starts to wake up again over the next couple of years, apart from anything else, because as I say, affordability is proving to be an issue.
Mm-hmm. Okay, so you would need to increase the yield, the gross yields that you bought at, and beware that gross yields are not the whole picture by a certain amount, depending on the area, depending on the strategy, and so on. And then we've also got that higher effort as a result of more regulations now and need to consider that. So kind of ballpark, do you have a benchmark that you use as you say, okay, well, I wouldn't buy at less than this yield in the current environment that you're willing to share?
Yeah, sure. I'm a little bit more complex than that because I always also factor in discount. So we must be adding value somewhere along the line, either from an auction purchase, a disposal, someone just wants to get rid of something and they're willing to take the best quick price they can, the 28-day price or whatever, or we're adding value via refurbishment, which of course is another thing that's got a lot harder over the past 4 or 5 years because construction inflation, materials inflation has taken that away from, it's gone up well above the cost of general inflation, and more than rent inflation has gone up as well. So the adding value through wet work, if you like, has become more difficult. I mean, if you were looking at the sort of numbers you needed to be at in terms of to be in the same proportionate ratio with what we were just talking about, you'd need to be buying stuff with 10% yields at the moment. I thought that was unrealistic even last year where rates were even higher, and was happy to look at stuff with 9% yields. But of course, at the time, especially, that priced out 90 something percent of the rental market in the UK. And I'm not talking sort of just do an HMO or a short-term rental, because gross yields are even less meaningful there because you've got costs to factor in, and you've got operational costs can often be more than half of the rent, especially in short-term rentals. So you've got to be clearing a good amount, and more short-term rentals were being created because they were various reasons, but more tax efficient. If people were suffering from holding assets in their own name after the 2015 tax changes, there were capital allowances placed. Potentially, there were lots of reasons for people to look at short-term rental, but there's very few barriers to entry to 1 and 2 bedroom flats being listed on Airbnb or Booking.com or whatever. So all you see then is you started to see oversupply come into that market, and it made it more difficult for people. So I would say at the moment, I think investment grade, and I'm looking at areas where I'm looking at properties where I'm going to get some kind of discount built in, which is going to pay for the frictional costs, stamp duty and the likes, and a bit more to get started on the right foot. And then I want the gross yield to be coming up to at least sort of 8.5% at the moment. If it's below 8.5%, it would be because I'm taking a view on that area being likely to outperform in capital growth terms, by which I'm saying there's an infrastructure project locally, or I'm expecting rent growth to outperform because rental affordability is still not pushing at the headroom of where traditional affordability metrics which have not been tested overall on average in the marketplace. Of course, they're tested every time you do a rental for certain households, but we're still finding tenants that are coming into places today have got comfortable affordability. And if rents were high, if market rent was higher, they could still afford to pay it. And therefore, there's rental growth we're factoring into the next 5 years worth of figures as well.
Super helpful. Okay, thank you very much. And I think with all the changes that we've talked about, property investment can seem quite complicated, I think, in the current environment. And as you said, you mentioned a couple of the different options. There's a lot of different options. Can you just run through what you see being the most compelling options for investors right now, and then ballpark what kind of returns might investors target over what time frame? And you've alluded to a few, but just to put the bigger picture on that.
Yeah, sure thing. So I think first of all, I feel about property investment, direct property and indirect, in the same way I feel about the stock market in general. You can't really look at it as even as short term as a 5-year play, unless you're going to be a property trader of sorts or similar. And of course, they are out there. You've got to be looking at 10-year returns and beyond. And as I say, you've got to be looking at the tax efficiency side of capital growth. So my personal views are that I don't see a good reason for us not to see 25+% general, I'm talking broadly across the UK here, returns on property prices over the next 5 years and 50% over the decade. I don't see a reason to be more bearish than that. Some of that is to do with latent inflation that's still left because of COVID. Some of that is to do with the fact that inflation has really adjusted nominal prices quite significantly, but no one in the market has necessarily seen that. And we still seem to fall into all these old traps where we say, oh, it's not as affordable as it used to be. But we don't really compare apples with apples. So, for example, 2004 versus 2024, if you adjust the average price of a house in the UK by the retail price index, RPI, which of course used to be the inflationary Bible before CPI came along, 2024 is 10% cheaper than 2004. Which most people struggle to believe, but that's where it is. And we keep having these conversations about, well, the average income, what multiple is it of the average income? But it's not the average income that turns into a homeowner these days. It's normally 2 full-time working professionals who are together and are able to scrape together enough to buy a house. If they aren't, then ultimately they're either relying on a very large donation or loan from the bank of mum and dad, or they're going to be in the rental market, realistically, because there's such a broad gap between what the average owner-occupier household earns and what the average rental household earns. And I think people find it a bit of a difficult conversation sometimes, but that's economics 101, really. There's no room for feelings in there. That's just the brutal reality of the numbers, unfortunately. So that's where we are. So when it comes to where are those sort of reasonable or outsized returns going to come? Well, a lot of this also depends on your attitude towards using debt, of course, because if you've bought well and then you're going to refinance to a 75% loan to value mortgage, hopefully you'll be able to pull out some of the money you used in the course of doing the transaction. Then you know that even a 3% growth per year in capital, if you've got 75% leverage, is ultimately going to return you 12% on your equity. Now, that's a bit back of the envelope, and that doesn't take into account things like transaction costs, things like CGT or corporation tax, depending on how you're holding it. And of course, it doesn't take into account future changes in the taxation system, because that's impossible to take those into account. But your returns are primarily going to come from some level of cash flow, which you might have to be quite patient on, because year one it might not look that good, but as long as you've bought in the right stuff in the right area where rents will continue to progress, you haven't got too much of a problem there on year 2, year 3. And then if you're buying at today's mortgage rates, I think it's a very fair expectation. I'd say there's a 80+% likelihood that in 5 years' time you'll be refinancing again at a lower interest rate, primarily because over the course of the next 20 to 30 years, I think there's a broad consensus view that really interest rates will come back down in the UK, mostly because it's post-industrial, struggling to grow. We'll be looking at 1% growth. You've got economies like Japan to look at. We've got demographic issues that are not maybe quite as current or present as Japan's or Italy's or things like that. But you can look at some of these older, more developed economies. And when I say older, I mean in terms of the average age of the population, apart from anything else, and see the sort of challenges they're facing and how they need very low interest rates in order to stimulate any kind of growth under the current system. So I think you can still be looking at double-digit returns within property if effectively managed. You buy the right sort of stock. You manage the assets. Even if you're using agents and things like that, you're on top of your asset management, which will include, I'm afraid, raising your rents every year, apart from anything else, and being on top of that. And then assessing the market as and when between tenancies, as mortgage rates come to an end, etc., regardless of how the rules change. At the moment, anyway, there's no appetite for not allowing people to regain control of their assets if they want to sell them, apart from anything else. So even the most extreme on the left, I don't think are really banging that drum too hard with any realistic notion of it being adopted. So certainly not in this. Once this renters' rights bill has come through, biggest change in 35, 36 years in housing law, 37 years probably by the time it goes through, that should put that subject to bed for another couple of parliaments, I'd imagine, unless there's some serious damage there. So double digit, we target certainly north of 20% IRRs and general rates of return. Sometimes we buy and sell in order to achieve that, because sometimes in the second years and beyond, you're not necessarily seeing that. It really depends on what you think the asset is worth versus what the surveyor has told you it's worth versus what you could get if you put it on the market today or tomorrow, I guess, Anna.
Right. And that is a whole nother topic, especially in the days where most valuations are done by machines. But we won't dwell on that for too long. So that was super, super helpful. Thank you very much. And it was also helpful to hear the distribution of returns and your thoughts on capital growth. And a lot of investors aim for the kind of passive property portfolio that we talked about before. However, of course, the reality can be quite different. I wondered if you can share some of the practical strategies for if an investor wants a hands-off investment portfolio, how can they actually diversify their income without taking on a second job?
Yeah, I meet people all the time who sort of fly in the face of this, actually. And I marvel, on one side, I marvel at the workload they must have. On the other side, I worry about the compliance they must not be doing, to be honest, Anna, because I know plenty of people who've got very well-paid jobs who are then parking the extra proceeds that they get every year in properties and managing them themselves. Use an agent to find the tenant, and then they do all the property management and maintenance. And of course, if all your properties are within a few mile radius and you've got a couple of really good contractors on the phone as well, maybe they just look after it in that way. But I think it depends how much you want to scale and how much of a hard time you do or don't want. Because if you've got a bigger operation, you need someone, if it's not you, sitting on top of the agents who are managing stuff. Even if you're managing things in-house, you need an asset manager style character who is on top of that to make sure performance is there, to make sure you're making the most of the asset. So in between voids, is it time to put that extra bedroom in? Is it time to revamp the garden? Is it time to do what will make the tenancy more attractive? You're not really going to get that from an agent necessarily, apart from you might do from a really spectacular one, but I wouldn't be relying on an agent to provide that for you. So it's one of those things where if you don't know who your asset manager is, it's you. That's for sure. And you do need quite a lot of units or quite a lot of rent roll anyway, in order to be able to employ an asset manager. Although, of course, you can get people on fractional bases these days, as you well know. So you might be able to find someone who gives your portfolio 14, 15, 16 hours a week on an hourly rate and manages it in that way. And you haven't then got the hassle of employing people. You haven't got all the rest of that goes on. So don't think that you necessarily need hundreds of units to make that happen. You don't. And of course, it depends on your level of gearing and how much cash flow you've got, because coming back to that point, there isn't always tons and tons of cash flow every month in this game, especially if you're reinvesting for growth.
Yeah, I was actually thinking about indirect investment as a way to diversify income,
right,
rather than direct, just purely because I'm not sure if I'm like you. I'm not sure I believe that direct property investments are particularly passive. But so do you have any experience? I mean, I know you have experience with indirect investments. Can you talk about them as a way to access, I suppose, returns, if not income, without taking on a second job?
Absolutely, yeah. So, I mean, there are obviously things like real estate investment trusts available, where depending on how interested or not you are in the broader market and the landscape for the next 5, 10 plus years, you can target certain things in terms of industrial to supermarket to various grocery to retail, if you're brave enough for that, or resi, or a more blended approach. So The benefit for the REIT is that they're not paying corporation tax, although you'll still pay dividend tax on your dividends. Of course, that depends on how you hold the investment. If you're using a tax efficient wrapper of some kind, and they can be returning. And it's an interesting world all of its own, because you need to be aware of things like they're often trade at a discount to what their NAV, their net asset value. That is sometimes a bit of marketing trickery to an extent. It just means things haven't been revalued, and funds have gone down in value, especially commercial funds over the last couple of years, simply because they're very sensitive to the interest rates. But of course, like any of these sort of investments, you can peel the onion back a little bit and look at the fact that, well, actually, that REIT has got fixed debt left for another 6 years at a nice low rate. And maybe I'm taking a view that in 6 years' time, the rates will have come back downwards a bit, and they've been kind of tarred by the same brush as the rest of the industry, if you like. Or maybe I'm taking a view that there are not enough great grocery sites for all the supermarkets that are expanding to want to expand into, and therefore one that already owns a portfolio of good sites is probably going to see quite a bit of capital appreciation that's not just about rate sensitivity and things like that. So there are ways and means to hold that sort of thing, or there are crowdfunding platforms available, obviously, where you can invest through things like intelligent finance ISAs and things like that. First charge debt, largely speaking, solid returns, a bit like a bond, which is a lot of the reasons why a lot of institutional investors use things like REITs apart from anything else. They want to mimic the performance of a bond, but they're looking for a bit more. So they're hoping for a bit of inflation protection, because if you go and buy a government bond with inflation protection, you'll return about 0.75% a year at the moment. And there's certainly been times where you've been returning a negative amount to pay for that inflation insurance, if you like, or that insurance protection, that inflation protection. So you're looking at, something that can and should appreciate in value over time, that is also throwing off some kind of yield. And as we said earlier, probably more in the 4-5% region, and you are taking a punt on the share price. And look, this stuff isn't free. They're very talented guys and girls that tend to run these things. They command reasonably big fees, but they've got a lot of property, so they can afford to pay it. Percentage terms, it doesn't look so bad. But what you gain on the corporation tax saving, you may well lose on slippage in terms of the costs of running the REIT. And of course, you've got no say whatsoever, but you have got something that trades on a market. You just need to remember that if you're thinking this is going to be, just because it's in a market makes it liquid, well, in theory it does. But the problem is, when everybody wants to sell is the time when nobody really should be selling, because the price has come down so much. So you have to remember everybody else and the way the market works as a whole, rather than thinking, oh, great, if it starts to perform badly, I'll just get out. Well, you might be then taking a 20% haircut to do that. That's the problem. And it's probably more likely to be looking at buying in those situations than selling. So I wouldn't consider it to be overly liquid. But of course, you've got strategies you can use, like pound cost averaging or dollar cost averaging, where you just put a regular amount in every month or every quarter or whatever, and not worry too much about the overall performance, because by doing that, when the price is low, you'll buy more. When the price is high, you'll buy less. So you're kind of protecting yourself from the buy high, sell low mentality that so many retail investors get themselves stuck in.
Super helpful. Wonderful. Thank you. Given the current challenges and opportunities in the market, what would you caution investors against doing at this time, and what common mistakes can people be wary of or aware of?
Well, I think mistakes, if in terms of direct, I think people who've not put work, time and effort into properties over the years, because the number one mistake, whether it be resi or commercial, is thinking you can just sweat assets forever and you're not going to need to reinvest in them. And ultimately, if that happens, then you're going to release it at a time like this, where the market has been a bit wobbly. And if you're talking about selling stuff with tenants in situ, for example, that are on below market rents, you're really going to be punished significantly for that at a time like this. So it's thinking about exit times and being prepared not to exit when everybody else wants to. And if anything, wanting to buy when everyone else wants to exit, which is a little bit contrarian, but it's that old Warren Buffett, be fearful when others are greedy, be greedy only when others are fearful quote that I like so much. So doing the same as everybody else will always yield the same results as everybody else. Of course it will. So you've always got to think like that, whether you're thinking direct or indirect. So don't fall into those traps. I think I mean, me personally, this is why I try and spend some time forming my own viewpoints. So if I, for example, thought, well, I couldn't believe some of the low yields that purpose-built student accommodation was trading at a few years ago when interest rates were really, really super low, I'm now seeing even less of a premium over the cost of debt on purpose-built student accommodation, whilst the risks, in my view, have probably gone upwards. Although, having said that, in the Renters' Rights Bill, if it goes ahead as planned, there'll be a huge advantage for PBSA and a huge disadvantage for direct student HMO landlords, because there'll be effectively a two-tier regulatory system for the length of tenancies apart from anything else. So that could be an interesting thing. But look for things where there's a natural barrier to entry as a rule, or the barriers to entry are likely to improve over time rather than get lower. So my really simple example earlier on of 1 bed and 2 bed short-term rental units, I just don't think there's much of a barrier to entry. So if you think you're going to carry on making good profits in those, law of economics suggests, generally speaking, you're not going to, because that profit will get competed away in the end, and you'll be stuck with more effort and the same margin. So not making mistakes. Like, you want long-term sustainability, don't you? So where is that going to exist? Well, it depends, again, I suppose, on your view to how many people are going back to offices, what are the urban areas that are going to grow. But generally speaking, the one thing I think most people can agree on is that most of the urban areas in the UK are going to be growing from here on in. You can go and drill down a bit more into specific demographics and pick out the Bristols or the Coventrys and the Birminghams that are expected to outperform from a population growth perspective, and get to that level if you want to. I quite recommend it. I think staying on top of what the media is saying, but then also taking your own view rather than just following the herd, is probably the most powerful thing you can ever do. Because really, all the great stories I've ever heard from great investors normally start with, it was 2008 late on, and then this happened. Or Google share price had dropped 25%, and so we bought some. And there's loads more to it than that, of course, but ultimately the entry point is correct, and then it's about gauging the exit point depending on your long-term wealth and estate planning.
For sure. You make your money when you buy.
Mm.
And finally, for those looking to start or expand their property portfolio, have you got any parting words of advice or key steps that you think that people should follow in the current environment?
So I think, look at it as something that is going to need seed capital, and you're not going to be able to get that capital back in a very short space of time. You need to look at it as a 10-year project and beyond. Don't think about it as something that's going to create cash flow overnight for you, because really, if you want to build a portfolio, when there is cash flow, you'll be reinvesting it in expanding that portfolio. You can't really do both. Take lots of cash flow, make a living out of it, and also then expand the portfolio even further, without probably working yourself into the ground as if you've got 3 jobs at one time, because you end up having to project manage stuff for people or deliver other developments or all the other things you can do when it comes to exchanging time and money. So expect to reinvest, but make sure you get your structure right in the first place. So should it be in a limited company? If you're going to go at it in a reasonable sized way, of course, everyone's scenario is different, but probably depends on your attitude towards gearing and how much you need to use gearing. If you don't want to use debt, think carefully, because if you're then comfortable with things like REITs that we talked about earlier, they will use debt to a low level, quite a safe level. But some people might not want to use debt in their own personal name. They might not like the personal guaranteed side of things. There are lots of other options like that. So I would say indirect is probably for you. Try and make those regular contributions where you can, so you know what you've got coming in. And then look, start slow and steady. You can always ramp up later on. Don't try and build Rome in a day, because then you're going to expose yourself to the interest rate today, the market today. What if we do have a wobble, etc., etc. Move in a sensible way, but always be moving forward as much as you can all the time. There's always people, for example, I spent years trying to train myself how to find better deals. And in the end, I realized that I could carry on finding deals to an almost unlimited level, because if they're good deals, if I can't buy them or do them at the time's not right for me, I can still move those deals on somewhere else and make some income from doing that, for example. So Don't get caught into someone else telling you what your strategy is. Drink in as much as you can from everywhere. Build your own plan that suits you. There's nothing wrong with buying one a year for 10 years if you can afford to do it and you've got the money coming in. You'll be sitting pretty in 10 years' time, but you probably won't. You'll probably be sitting on, £1 million plus worth of equity, but not a huge cash flow from that. So be prepared for that. Make sure it's something that you want apart from anything else.
Wonderful. Ah, that was great. Super helpful. Before we close, I did want to just mention that you and I first met through a group called the Portfolio Landlords Action Network. And the core group is for investors with 75 or more properties. There is now an associate membership too. And I know that people organizing that are really keen to get the word out. So feel free to reach out to either Adam or I if you're interested in being part of that and feel like you should be. And finally, if listeners want to find out more about you, Adam, your business, or what you do, what's the best way for them to do that?
So best thing to do is come and connect with me on LinkedIn, Adam G. Lawrence, Adam Lawrence. I do have a website, propenomix.com. It's got MIX on the end. And you can find that I publish a newsletter every week on a Sunday morning. That is my thoughts on the broader marketplace, the macro pieces, the things that are the parts of the puzzle. And I usually do a deep dive every week on something that I found of interest that week or something that I think we should be talking about that we're probably not talking about in the wider headlines. So thanks for having me, Anna.
Thank you very much. Bye.